Usually when we talk about the financial markets, there is this comforting expectation that the dashboard makes sense.
Right, like the warning lights actually mean something.
Exactly. Think about driving a car, right? If your speedometer is pinned at an all-time high and you are cruising smoothly down the highway, you logically expect the engine temperature gauge to be perfectly cool.
The signals are supposed to align.
Right. Strong economy means high stock prices. So a very warm welcome to you, the listener, as you join us for today's deep dive.
Yeah, glad you're here. Because, I mean, it is supposed to be a logical system, but when you look at the current tech and economic landscape today, that metaphorical dashboard is just completely broken.
It really is.
We are looking at a diagnostic picture that is flashing red and green at the exact same moment. We have stock indexes hitting these historic all-time highs, while simultaneously massive macroeconomic and geopolitical alarm bells are ringing so loudly that they're basically impossible to ignore.
And untangling that massive contradiction is our mission for today. We're going to unpack a fascinating and honestly pretty urgent conversation featuring tech hedge fund manager Dan Niles.
It's a great interview.
It really is. We are going to explore why the current AI boom is structurally transforming the entire technology landscape underneath our feet, yet, and this is the wild part, why it might actually be heading for a massive 30 to 50% crash by the year 2027.
Yeah, that 30 to 50% number is definitely going to wake people up.
Definitely. But before getting into the source material, I have a quick message for you. To access more advanced researches, applications, and our latest published personal intelligent, multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for information and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
So getting back to the analysis, to really understand this potential crash and the incredible boom that is preceding it, we have to contextualize the core tension here.
Right.
How can the stock market be at absolute record highs while, oil prices are up 60% this year and bond yields are sitting at levels we haven't seen in ages?
It doesn't make sense on paper.
No, it doesn't. And Dan Niles frames this by forcing us to look backward. We basically have to figure out exactly where we are in the historical cycle to predict where we are actually going.
Okay, let's unpack this. Because when people see tech stocks exploding, the immediate lazy reflex is to just say, oh, it's 1999 all over again.
Right, the classic dot-com bubble comparison.
Exactly. Everyone thinks we are at the peak, Pets.com is about to go bankrupt, and it is all about to pop. But Niles specifically argues we are absolutely not in 1999. He actually compares our current moment to 1997 and 1998.
And what's fascinating here is the nuance of that comparison, because 1997 and 1998 were incredibly turbulent years.
Oh, massively turbulent.
Yeah, they were characterized by huge macro shocks. I mean, in 1997, you had the Thai currency crisis, which actually caused the S&P 500 to drop 11% during the year.
Wow, 11% is a big hit.
It is. Then in 1998, you had the Russian bond default and the collapse of the long-term capital management hedge fund.
Oh, LTCM. Yeah, I remember reading about the absolute panic on trading floors back then.
It was pure panic. That triggered a really painful 19% intra-year drop.
But wait, how did those years end up finishing?
Well, that's the thing. Despite those massive macroeconomic shocks, the market finished 1997 up 31% and 1998 up 27%.
Wait, really? Up 31% after an 11% drop.
Exactly. And the reason why is crucial for us today. Underneath all that geopolitical panic, there was this unstoppable structural build-out of a brand new infrastructure.
The internet.
Precisely. The physical fiber optic cables were being laid down.
So the engine was just too powerful to be derailed by the macro shocks.
You got it.
So Niles is saying today's macro shocks, the conflicts in the Middle East, specifically involving Iran, the soaring oil prices, those are our modern versions of the Thai currency crisis or the Russian default.
Exactly. They cause severe turbulence, sure. But the underlying engine pulling the market upward right now is the physical infrastructure build-out of AI, specifically year 4 of this AI cycle.
Year 4. So if we peg the launch of ChatGPT at the end of 2022 as the starting line.
Right. We are 3 years in, entering year 4.
Okay, so we are right in the thick of the physical infrastructure build-out. But what is driving the absolute explosion in capital expenditure right now isn't just basic chat AI, right?
No, not at all. It is the transition to something called agentic AI.
I really want to spend some time here because this fundamentally changes what we are actually asking computers to do. Let me use an analogy for you.
Sure, go for it.
Chat-based AI, like the early versions of ChatGPT, is essentially like walking to a library and asking the librarian for a recipe for a chocolate cake.
Right. They hand you the recipe and their job is done.
Yes, very transactional, single query in, single output back. But agentic AI, which really started hitting the mainstream with models like OpenDevin or advanced Claude agents early this year, is entirely different.
It's a whole new ball game.
It's not a librarian at all. It is like handing an intern your credit card and saying, go to 3 different grocery stores, compare the prices of the ingredients, buy the cheapest ones, bring them back to my kitchen, and bake the cake.
That is a brilliant way to picture it. You are giving the AI a broad objective, and it has to autonomously execute multiple sequential steps to get there.
It has to do the heavy lifting.
Exactly. It has to open a web browser, scrape a news site, log into a terminal, pull financial data, open an Excel spreadsheet, format the data into a chart, and then email it to you.
And here's where the math gets wild. To do all of that, Niles points out that agentic AI requires 10 to 100 times more tokens to be generated than a simple chat query.
100 times more. Just think about that.
Let's actually clarify what a token is for a moment, because we hear that word thrown around constantly in the news. A token isn't a full word, right?
No, it's a fragment of a word or a piece of data that the AI uses as its fundamental unit of computation.
Okay, so if you ask for a recipe, it generates a few hundred tokens. But if your AI intern is actively browsing the web, reading full articles, and comparing spreadsheets in the background for 20 minutes.
It is burning through millions of tokens continuously.
Wow.
Yeah, and if we connect this to the bigger picture, that 10 to 100 times increase in tokens is a 10 to 100 times increase in computational energy and physical hardware.
So it's not just an abstract software concept.
Not at all. You can literally see it in the physical world by looking at the capital expenditure, the CapEx projections of the hyperscalers.
And by hyperscalers, we mean the massive cloud computing providers, right? Like Amazon Web Services, Google Cloud, and Microsoft Azure.
The ones physically building the football field-sized data centers.
Okay.
Correct. So
Yeah.
at the start of the year, those hyperscalers projected their CapEx would grow by 30%.
Which is already a huge number.
Oh, massive. But then a few months later, they revised it to 60%. And a few weeks ago, they revised it again to 70% growth.
70%.
Yeah, they are frantically buying hardware to support this digital intern that needs to do 100 times more computational work.
Okay, I'm going to push back here, though. I thought NVIDIA's GPU's graphics processing units were the undisputed kings of the AI boom.
They definitely have been up to this point.
They've been the poster child for this entire movement. So why is Niles suddenly arguing that we need to look away from GPUs and start looking at CPU central processing units?
Well, this raises a really important question about how the architecture of AI is evolving, and it gets to the core of why agentic AI is so different.
Okay, break that down for us.
So GPUs are phenomenal for training AI models. Training requires doing the exact same mathematical calculation millions of times simultaneously across vast data sets.
Like brute forcing the math.
Exactly. That parallel processing is a GPU's superpower. But agentic AI isn't about training anymore. It is about execution, or what the industry calls inference and orchestration.
Orchestration, meaning managing the actual workflow of the task itself.
Precisely. Opening the Excel file, going to the SEC website, managing the memory of what step it just completed so it knows what to do next.
I see.
CPUs are the ideal orchestration engine. They are not built to do a million simple math problems at once. They are built to handle complex sequential logic and juggle different applications rapidly.
So the physical hardware of the data center actually has to physically flip to accommodate agentic AI.
Yes, and the ratio shift is staggering. According to the sources, during the initial AI training boom over the last 3 years, data centers were buying roughly 8 GPUs for every 1 CPU.
8 to 1.
But with agentic AI taking over the workload, that ratio is moving closer to 1 to 1.
Wait, really? 1 to 1? There's a massive structural shift in where the billions of dollars of hardware money is flowing.
It is, which breathes new life into legacy players that many people had completely written off as dinosaurs.
Like who?
Take Intel. Niles notes that Intel has basically been considered dead money for decades. Its stock just recently crawled back to the peak it hit in the year 2000.
The year 2000. That implies 26 years of zero stock price growth.
It is remarkable. But if you look at their enterprise value to sales ratios compared to an AMD or a Taiwan Semiconductor, they are deeply undervalued.
Let's break down that metric for the listener. Enterprise value to sales basically asks, If you bought the entire company, including its debt, how much are you paying for every dollar of sales it brings in the door?
Right. It is like evaluating a local bakery based solely on its cash register receipts.
And Intel's ratio is incredibly low compared to its peers, meaning it is priced almost like a distressed asset right now.
Exactly. But as the demand for CPUs skyrockets for agentic AI, Intel is perfectly positioned. This is especially true as they build out their domestic foundry business in the United States to secure supply chains for companies like NVIDIA, Apple, and Tesla.
And AMD is another direct beneficiary of this architectural shift towards CPUs, right?
Yeah, absolutely.
Okay, so if the physical hardware foundation is fundamentally changing from GPUs to CPUs, the software giants sitting on top of that hardware are going to face a reckoning.
Oh, big time.
How are the Magnificent Seven, the giant tech monopolies, faring as the ground shifts underneath them?
According to the analysis in the source material, there is a clear, undisputed winner for the next 3 to 5 years, and it is Google.
Really? I'm struggling to buy the Google dominance narrative.
How so?
Well, everyone is talking about Microsoft's partnership with OpenAI. The whole narrative for the past 2 years has been that Google fumbled their initial AI rollout and is just playing catch-up. Why does Niles crown them the winner?
What's fascinating here is the concept of owning the full stack. When an architectural shift happens, the companies that control every single layer of the ecosystem are the most insulated.
Okay, that makes sense.
Google doesn't rely on OpenAI like Microsoft does. They have a leading large language model in Gemini, but more importantly, they design their own internal AI chips called TPUs, which they've been iterating on for over a decade.
Right, so they control the hardware and the software.
And they have a massive cash printing advertising business to fund that 70% jump in capex we discussed earlier. And crucially, they control the distribution.
The distribution piece is huge.
Yeah.
I mean, over 75% of all smartphones sold globally run on Android. They own the operating system.
Right.
If they want to push an agentic AI update to billions of people, they literally just flip a switch.
You don't have to guess if this strategy is working either. You just look at the numbers. Google Cloud's year-over-year growth rate recently accelerated from 48% to 63%.
Wow, 63%.
Uh-huh.
That is a massive structural jump in revenue for a company of that size.
It really is.
You contrast that full stack dominance with a company like Meta. Meta has some glaring structural vulnerabilities right now.
Yeah, they do.
They release an incredible open source model, but they don't have a public cloud. Amazon, Google, Microsoft, they can rent out their excess AI compute power to other companies when they aren't using it. Meta cannot.
That's a huge disadvantage.
And even more terrifying for their business model, they just reported their first sequential decline in history of people using their family of apps.
Which is wild, because if your entire business model is based on capturing human attention to show them ads, and the number of users stops growing or starts shrinking, while your infrastructure costs to build this AI are exploding by 70%.
The math starts to look very, very dangerous.
Exactly.
Now, Apple is in a fascinating spot as well. Their initial foray into spatial computing, the Vision Pro headsets, basically flopped.
Yeah, the ski goggles didn't really catch on.
Right. But Niles points out they might be on the verge of a hardware supercycle. If they integrate a true agentic AI into Siri, making it incredibly smart and autonomous, and combine it with a new physical form factor like a foldable iPhone,
We could see a massive upgrade wave.
it could mirror the supercycle we saw when they introduced the larger screen on the iPhone 6. Their revenue went from 7% growth to 28% growth the very next year.
People treat iPhones like consumer staples, almost like buying milk or bread. They will upgrade if the AI utility is actually there.
They will.
Yes.
This is exactly where the narrative takes a dark turn.
Yeah, we have to talk about the dashboard again.
Exactly. We have spent the first half of this deep dive talking about the incredible leaps in agentic AI, the hardware shifts, the resilience of these trillion-dollar tech titans.
But there is a ticking time bomb in the broader economy that AI simply cannot out-innovate.
Here is where it gets really interesting, because this brings us back to our broken dashboard from the beginning. You have the stock market sitting at all-time highs, yet oil prices are up 60%.
50%.
And the 30-year bond yield recently hit 5%. Niles looks at this and says, plain and simple, one of these is wrong.
It is a glaring contradiction. Let's explore the oil piece first. 10 out of the last 12 economic recessions were preceded by a sustained spike in oil prices.
10 out of 12. That's not a coincidence.
No, because oil is the physical lifeblood of the global economy. It seeps into the cost of literally everything, it drives up inflation, it increases transportation costs, and it saps the everyday consumer's spending power.
We are already seeing companies like McDonald's reporting that their lower-income consumers are highly stressed and pulling back on spending.
Exactly. And if oil stays high, that stress moves up the economic chain until it breaks something.
The other major headwind is the AI return on investment problem, the ROI cannibalization.
This is a huge point.
We see these staggering revenue jumps for AI software companies. Anthropic is reportedly hitting a $35 billion annualized revenue run rate.
Which is unbelievable.
OpenAI is hitting $24 billion.
Yeah.
That is up from practically nothing just a couple of years ago. But where is that money actually coming from?
That is the billion-dollar question, because it isn't new money being magically printed. It is being drained from the existing IT budgets of other corporations.
Oh, so it's a zero-sum game.
In many ways, yeah. Every company using OpenAI or Anthropic has to show a return on that investment to their shareholders. If a massive Fortune 500 company is suddenly spending billions on AI integration, they're cutting billions from other software vendors, consultants, or even their workforce.
So eventually that cannibalization is going to hurt overall corporate earnings across the broader stock market.
Exactly, it has to.
But the piece that really blew my mind from the sources, though, is the liquidity vacuum.
The IPOs.
Yes, we are facing a wave of massive mega IPOs, initial public offerings. OpenAI, Anthropic, SpaceX, they are all likely going to go public in the near future at valuations well over $1 trillion each.
Right.
Can you walk us through the mechanics of why that actually triggers a market sell-off? Because it seems counterintuitive.
Yeah, to understand why a successful IPO could crash the market, you have to understand the mechanics of passive investing. A massive portion of the stock market is held in mutual funds and index funds. These funds are mathematically required to track specific benchmarks, like the S&P 500, weighted by market capitalization.
Meaning, the bigger the company, the larger percentage of the fund it must make up?
Right. So if a trillion-dollar behemoth like OpenAI enters the public market and gets added to the index, those funds are legally mandated to buy it so their portfolios accurately mirror the index's new makeup.
They don't have a choice.
No choice at all. But they don't have infinite cash sitting in a vault waiting to be deployed.
Oh.
Let's say a fund has $100 billion fully invested. To suddenly buy $3 billion of OpenAI stock to match the new index weight, they have to physically sell $3 billion of their existing holdings.
Things like Apple, Microsoft, or NVIDIA, just to make room.
Exactly.
Okay.
This creates a massive, forced, mechanical sell-off in the rest of the market. It literally drains liquidity right out of the system.
Wow. So you combine a forced algorithmic sell-off from mega IPOs, the budget drain of AI costs eating into corporate profits, and the crushing weight of high oil prices.
And that is exactly how you get Niles forecasting a 30 to 50% crash by 2027.
Once the initial physical infrastructure build-out of AI anniversaries itself and the spending slows down, gravity basically takes over.
Gravity always wins.
Which leads to a very clear, actionable takeaway for you, the listener, as you navigate your own portfolio. The resounding advice from Dan Niles is, be nimble.
Be nimble, because it really comes down to basic risk versus reward. If the 30-year government bond is offering a guaranteed 5% return, you have to ask yourself a hard question.
Are you willing to risk your capital in an overheated, irrational stock market that could potentially drop 40% just to chase a few more points of tech growth?
Right. When you can lock in 5% risk-free, the math of investing in high-flying tech changes dramatically. A higher cash or bond weighting provides shelter when the dashboard signals conflict like this.
It is all about protecting your wealth. But before we wrap up, I want to look past the crash.
Okay, let's zoom out.
If Agentic AI is the story of the next 3 years, what is the story of the next decade? What is the next paradigm shift on the horizon?
The horizon is absolutely quantum computing. Niles quotes Bill Gates, who famously observed that technology is often vastly overhyped in the near term, but deeply underhyped in the long term.
And quantum computing fits that paradigm perfectly.
It does.
But, you know, it feels like we've been hearing about quantum as this sci-fi concept for decades. What makes it different from the AI build-out we just discussed?
Think about the timeline here. The earliest academic papers on artificial intelligence were written over 50 years ago.
Oh, yeah, back in the 60s and 70s.
Right. It took half a century of slow, agonizing iteration to finally get to ChatGPT. Quantum computing is currently where AI was 50 years ago. We're going to start seeing quantum companies IPO soon, which will draw a lot of hype and capital to the space.
But to understand why it is so disruptive, you have to understand the mechanics, right? Let's ground it. How does it actually work compared to the computers we use today?
Well, a classical computer, even the most advanced AI supercomputer today, processes information in bits, which are either ones or zeros.
Okay.
Imagine a classical computer trying to solve a complex maze. It has to walk down one path, hit a dead end, backtrack, and try the next path. It does this very fast, sure, but it is sequential.
One path at a time.
Exactly. Quantum computing uses qubits, which can exist in a state of superposition. This means they can be a 1 and a 0 at the exact same time.
So using the maze analogy, instead of trying one path at a time rapidly, a quantum computer is like, well, it's like pouring water over the entire maze.
Yeah.
It explores every single possible path simultaneously.
That is a perfect analogy. It solves problems in seconds that would take a traditional classical supercomputer millions of years to compute.
That's just hard to wrap your head around.
It is. But there is a massive push-pull dynamic here for investors. Because if a company actually achieves a true, scalable quantum breakthrough, it doesn't just create a new market.
It destroys the old one.
Exactly. A true quantum computer would cause a catastrophic fall-off in demand for classical computing. Everything we've just talked about today, the CPUs, the GPUs, the silicon foundries, could face an absolute existential crisis if quantum actually scales.
It is the ultimate creative destruction.
Yep. The ultimate reset.
Okay, so what does this all mean for us today? Let's synthesize this deep dive.
Sure.
We are entering year 4 of the AI infrastructure build-out. The transition from chat-based AI to autonomous, agentic AI is forcing data centers to burn through millions more tokens and do 100 times more work.
Right, the intern versus the librarian.
Exactly. And this is driving a massive hardware architectural shift away from GPUs and towards CPUs, benefiting legacy orchestration companies like Intel. Meanwhile, at the software layer, Google's full-stack dominance owning the chips, the models, and the mobile distribution makes them the clear favorite over the next few years.
While companies without their own public cloud, like Meta, face real structural vulnerabilities.
But despite those incredible technological leaps, the macroeconomic dashboard is flashing red. Between 5% bond yields, surging oil prices, the ROI reality check of AI spending cannibalizing corporate budgets, and the looming liquidity vacuum of trillion-dollar IPOs.
The sources point to a very bumpy road ahead.
Potentially a 30 to 50% correction by 2027. You have to be nimble, and you cannot ignore the safety of cash or high-yield bonds in this environment.
It is about keeping your eyes wide open, understanding the underlying technology shifts, but respecting the gravity of macroeconomics.
That's it.
Which brings me to one final provocative thought for you to consider. Something that wasn't explicitly spelled out in the macro analysis, but is a direct mechanical consequence of everything we've discussed today regarding agentic AI.
Oh, I like where this is going. What is it?
Think about that intern we talked about earlier. The agentic AI that goes out and bakes the cake for you. If agentic AI functions by autonomously going out into the internet, reading the articles, scraping the data, bypassing the paywalls, and synthesizing all of it for you in the background.
It means human beings are going to fundamentally stop visiting websites.
Exactly. You won't be scrolling through web pages or blogs. You will just be reading the summarized, perfectly formatted result in your AI chat window.
Wait, if we stop visiting websites and human eyeballs stop seeing the banner ads, the pop-ups, and the sponsored links?
What happens to the trillions of dollars of corporate valuations built entirely on the digital advertising ecosystem?
Oh, wow.
The dashboard says the tech giants are invincible right now, but the very technology they're spending billions to build might be mechanically designed to dismantle the business model that made them giants in the first place.
That is a staggering thought to leave on. Thank you for joining us on this deep dive, listener. Keep questioning the consensus, keep checking the dashboard, and we'll see you next time.